Hey, good evening. Dan Fitzpatrick here, Stock Market Mentor. And it's Wednesday. I'm going to give you either Thursdays or Fridays trade. I can't give you Wednesdays. Actually, I'll tell you Wednesdays. It's all on the same stock. Cardlytics. So, the company reported earnings, and I think they had some other stuff, kind of, nasty stuff happen. Stock gaps down 30-some%. And hey, man, in my world, a stock that's down 30%, unless the CEO's name is Kenneth Lay or something like that. Well, that's before your time. That's a stock that I'm looking to buy for a bounce, like just kind of the rubber band thing. And so that's actually what I did this morning, waiting and waiting and waiting, right? But I was actually on the 1 minute chart, and I waited a bit. Let me get this to you here. So, first thing in the morning, I have what I call a 59-minute trade technique, and there's a reason why it's not the 60-minute trade technique. Two reasons, actually. First of all, that domain name was taken. But also, you want to wait at least a minute to kind of see how things settle out. Sometimes 3, 4, 5 minutes or so. You want to see which way the stock's going. So, I waited the minute, and that leads us to, that takes us to here. And so then I'm looking at this. I think, okay, well, I'll go ahead and buy this stock. I know it was below 60. Probably around 59.50 or so. I'm thinking, okay, well, shoot, man, this is a big old nasty sell-off. I think that we're going to get a pretty decent bounce. I don't know how high we're going, but I've at least defined my risk. And my risk is just below this intra-period low, like first thing in the morning. What was that low before the stock reversed and started to move higher? So I've got my stop down there, right? Okay, and so then I'm long the stock, and then the stock breaks out above the opening rotation, above the opening print, where it opened. The stock breaks out above there. Then I added to my position. So I took, not a huge position, not in this market, but my second buy. Bought some right here, felt good about that. When this breaks out, I'm buying some more. So I got a decent sized position for the type of trade that I'm doing. Then it runs into $62, like, a flipping basketball player, doing, jump shots in the basement of a really low hanging building. I don't even know what that means. But and so the thing bumps its head there, and I keep waiting, and I'm waiting, and then it starts to drift lower, and I'm still waiting, and right about here I'm kind of getting uneasy, so I cut down my position here because the idea was, hey, if this thing, after this kind of move, if all it could muster was like $4 from bottom to top, buy at the exact low, sell at the exact high here. This is under a lot of pressure. So I kind of lightened up, actually raised my stop on the remaining. So it was no longer here, it was actually up a little higher. And then consequently got stopped out. And I lost money on the trade. And in hindsight, hey, should have sold there. Well, fine. If I could use hindsight as a trading method, I would only have winning trades. Anyway, so I took a small loss on this trade. That's okay. Too bad, so sad. But so now what do? All right, well, I'm still looking at this stock. And I'll tell you why. Because the red lines here, this is 3 standard deviations. Stocks generally don't go out 3 standard deviations from their 20-day moving average. When they do, it's kind of like they broke the law. I mean, think Michael Avenatti or something. Like, when a stock breaks the law like this, you really do want to see it in the slammer. Back here, the stock broke out above 3 standard deviations. Okay, and then it still continued to do okay, not great, but it did drift sideways back within the Bollinger Bands. But that stock gapped out from a volatility squeeze, so it was really tight tight trading, and then boom, the stock goes up and traded outside these the Bollinger Bands that and then they expand. They keep moving higher as the price drifts sideways, and so consequently they fall back within the bands, which is what they're supposed to be doing. You know, this is a standard deviation thing. It's a math thing, statistics. So now we have this in a little different situation, though. This didn't fall down out of a squeeze. It just, you know, these were kind of wide to begin with. The stock was trading in a 30% range from top to bottom. So this is a stock that we could see this go even lower, but if I were a betting man, and I'm not, I would bet that sometime over the next week, this stock is going to be above this 54.55 level. In other words, the big move outside 3 standard deviations at some point is going to snap back and come back into the fold. Whether it happens tomorrow from here, or whether the stock goes down a bit more and then happens on Friday from here. I don't know which, but I know this, the 200-day moving average. Ideally, we get a little more selling. Stock comes down to test the 200-day moving average right around 50, and then boom, that's when you're going to get a nice reversal. So this is kind of advanced swing trading stuff. But my point for going through all this is to tell you, number one, look, I made a losing trade on this, but I know, I knew exactly what I was looking for and I just didn't get it. Number two, I think the stock is ripe for a rebound, and a pretty healthy rebound. We just don't know what level it will rebound from. So it's not like go buy this stock tomorrow. Just watch it. And then number three, I'm going to trade this stock and make back the money that I lost today, right? Wrong. Number one and number two, sure. Number three, no. That's just lost money that I don't get back. I don't get back at stocks. I just trade. And that's what I would suggest you do as well. But watch Cardlytics here for the next few days. I think you'll see some kind of a tradable rebound. Okay, that's it. I'm out of here.